Welcome to The Deep Dive. We're the show that takes a heap of information and boils it down to what you really need to know. Today we're diving into Greif Inc. That's ticker GEEF. They just had their third quarter fiscal 2025 earnings release. Our job here is to cut through all the noise from that call and give you the essentials, especially since Greif is going through, well, a pretty major portfolio change right now. We'll start with a quick look at the results, then really unpack what it all means. So let's get right into it. Greif reported kind of a mixed Q3. On the surface, GAAP EPS for their Class A shares was $0.67. Adjusted EPS came in at $1.03. Now that adjusted number, $1.03, it did beat the Zacks consensus of $0.92.
Right. But
it actually fell short of FactSet's estimate, which was $1.12. And revenue from continuing operations, that was $1.135 billion. That's down 2.6% year over year. And it also missed the FactSet consensus, which was $1.47 billion. So yeah, top line looked a bit soft. But here's where it gets interesting. Despite that dip in revenue, the company reported a pretty impressive 11% year-over-year jump in combined adjusted EBITDA. Came in at $220.9 million.
Wow. Okay.
And adjusted free cash flow. That saw a huge surge. It was up $136.4 million compared to last year, hitting $170.7 million.
That's significant cash flow.
Definitely. Plus, their leverage improves quite a bit. Came down from 3.6 times to 3.1 times. The market reaction was, let's say, cautiously optimistic. Shares traded modestly higher after the call, which suggests investors are, largely okay with Greif's transformation and this strong cash generation. Looking past some of those headline misses, maybe.
I think that's exactly right.
So what's driving this? Revenue down, but EBITDA and cash flow up. And what were the sort of big strategic themes this quarter?
Yeah, that's the key question, isn't it? And it really gets to the heart of Greif's Q3. What's truly defining things for them right now is, well, less about just growing the top line traditionally and much more about this significant portfolio reset they're undertaking. Plus, they have this laser focus on cost optimization and just generating cash. It's really a fundamental reshaping, not just tweaking things around the edges. And the cornerstone of all this, it's definitely those strategic divestitures. Huge news. They're in the process of selling their containerboard business to Packaging Corporation of America, PCA, for $1.8 billion. Target closing date for that is August 31st, 2025.
Okay.
And on top of that, they've got a definitive deal to sell their Timberlands business, which is known as Soterra. That's for $462 million. That one's targeted to close by October 1st, 2025. The timing there is quite strategic, actually.
How so?
Well, it's aimed at favorable tax planning. They think it'll save them about $13 million in taxes permanently. So these aren't just, selling off assets randomly. These are moves designed to really sharpen Greif's portfolio. They want to concentrate their efforts on markets with better growth potential, better margin expansion. The goal's pretty clear: enhance capital efficiency and deliver more durable shareholder returns. The combined net cash proceeds from these two deals, expected to be around $1.75 billion, and management thinks that'll slash the company's leverage ratio way down to below 1.2 times.
Right, so these divestitures are obviously massive game changers. But you also mentioned cost optimization as another key driver. Can you elaborate a bit on that? How are they getting these efficiency gains that are pushing EBITDA up even when volumes are, soft?
Absolutely. So beyond these big divestitures, Greif is really aggressively ramping up cost optimization. They've already hit $20 million in run rate savings. That's towards their fiscal 2025 goal, which is $15 to $25 million.
Okay, they're well on their way then.
Exactly. And this includes about $15 million in SG&A reductions, that's selling, general, and administrative costs, plus network optimization initiatives. For example, they announced they're closing a plant out in Set, California. But what's also really interesting is they highlighted some smaller things too, smaller improvements in operating efficiency that still have an impact.
Like what?
Like a 40% improvement in line efficiency at their Welcome, North Carolina core plant.
40%.
How? Just due to better changeover processes. It's a classic example of what they call the aggregation of marginal gains. It emphasizes that, lots of small wins can really add up and move the needle, especially when demand is challenging.
Yeah, that aggregation of marginal gains idea really makes sense, doesn't it? Especially when those big headline wins are maybe harder to come by. It shows discipline. Before we dive into what this means for investors, were there any big leadership changes announced on the call?
Yes, there was one notable transition mentioned. The CEO, Ole Rosgaard, took a moment to recognize Gary Mutz. He's the Executive VP, General Counsel, and Secretary. He'll be retiring later this year after, get this, over 20 years with Greif.
Wow, that's a long tenure.
It really is. Dennis Hoffman, who's currently the Deputy General Counsel, will step into Gary's role starting October 1st. Apparently, they've worked closely together for 15 years, so it seems like a pretty smooth, well-planned internal transition. Okay, now let's quickly just touch on how the different segments performed, just to give you a bit more granularity. Customized polymer volumes were actually up 2.2%. That was driven by low double-digit growth in their small containers. And key end markets like agrochemicals, pharma, flavor and fragrance, and food and beverage did particularly well.
So that focus is paying off there.
Management certainly thinks so. They believe it clearly shows their strategy is working in those targeted areas. On the other hand, durable metals volumes declined 5.8%. That was mainly due to softer industrial demand in North America and EMEA. Think sluggish housing and petrochemical markets really impacting that.
Right.
But here, management stressed their strategy of value over volume and cash generation. And interestingly, that actually helped improve their gross profit margins year over year, even with lower volume.
Okay, so prioritizing profit over just chasing volume.
Exactly. Sustainable fiber volumes were also down by 7.6%. That largely reflected those sluggish industrial markets in North America again. Integrated solutions volumes, though, grew by 2.6%, and that was boosted by strong performance in recycled fiber. The overall picture: customer sentiment remains cautious. The macroeconomy isn't exactly robust, particularly in North America and EMEA.
Okay, so yeah, definitely a mixed bag on demand. But it sounds like their strategic focus and the cost controls are really helping them navigate through it. Looking ahead, Greif reaffirmed its guidance for fiscal 2025. What are the key numbers there? What's kind of baked into that guidance, especially with these divestitures happening?
Right, they did reaffirm. For the full fiscal year 2025, they're projecting combined adjusted EBITDA between $725 million and $735 million. Adjusted free cash flow is expected in the range of $305 million to $315 million. Now, what's interesting is they actually tweaked the guidance slightly. The revised midpoint for adjusted EBITDA, this is for 11 months, mind you, was raised by $5 million to $730 million.
And why was that?
Primarily due to better SG&A performance coming from those cost optimization gains we talked about.
Makes sense.
And the revised free cash flow midpoint of $310 million. That was raised by a more significant $30 million. That's attributed to the EBITDA increase, but also lower expected CapEx spending. Apparently, that's just timing related.
Got it.
Now, here's a crucial point about that guidance. It still includes a contribution from the containerboard business for August and September. Specifically, $122 million in sales and $25 million of EBITDA because, well, the sale isn't final yet.
Okay, so that will drop out eventually.
Precisely. And those 2 months are typically the most profitable for their triple wall business because of seasonal demand. So that's important context. Looking further out, management expects significant operating leverage when demand does eventually recover. That's strengthening their confidence in hitting their 2027 target of $1 billion in adjusted EBITDA.
Okay, let's really try to unpack this from an investor's point of view now.
Yeah.
You've laid out this clear picture, the big divestitures, the impressive cost cutting. How do these moves fundamentally change maybe the risk profile of the company and its potential for long-term growth compared to, the old Greif? It really does seem like they're shedding that cyclicality for potentially enhance profitability.
I think that's exactly the right way to look at it. By selling off containerboard and Timberlands, Greif is, fundamentally streamlining things, and it provides a huge amount of capital, obviously. It drastically cuts their exposure to the more cyclical, more commodity-driven parts of their business. So the risk profile shifts, doesn't it? It shifts towards more resilient end markets, food and beverage, agrochemical, pharma. Those tend to have more stable demand patterns, and that also means their profitability should, theoretically, be less volatile. That allows for more predictable, maybe more durable returns over time.
Okay, that makes a lot of sense. So with leverage projected to drop below 1.2 times after these sales and all this cash coming in, their capital allocation strategy suddenly becomes, critical. What are their stated priorities? And how aggressive are they actually planning to be with this newfound financial firepower? Yeah,
they were quite clear on the priorities. First up, dividends. Then safety and maintenance of their equipment, keeping the existing assets running well. And after the initial debt pay down from the proceeds, the focus shifts squarely onto organic growth and M&A.
M&A, okay. What are they looking for there?
They're specifically looking for acquired businesses that are strong free cash flow generators, targeting 50% free cash flow conversion. And they want businesses with at least 18% EBITDA margins in those growth segments they've identified, like the polymer-based containers, caps, and closures we mentioned. Management said they have a solid M&A pipeline covering both smaller bolt-ons and potentially larger deals, but and this is interesting, they don't currently see any immediate transformational deals on the market. The really huge ones, say in the $3 billion range.
So maybe more manageable deals for now.
Seems like it. They also said they're comfortable operating within a 2 to 2.5 times leverage target range, but they are willing to go above that for the right strategic fits, mainly because they feel they've proven they can pay down debt rapidly when needed.
Right, they have a track record there.
Exactly. And just another point on the finances, those proceeds from the 2 sales are expected to save them around $120 million in interest costs next year. Yeah, even if they don't make any acquisitions right away. That's partly due to that favorable tax planning with the Timberlands sale timing. But here's maybe the biggest constraint they mentioned on deploying all this capital.
Not money.
No, not money. It's human capital. Their capacity, their team's bandwidth to actually execute projects effectively and integrate acquisitions smoothly. That's the real bottleneck, they say.
That's a really insightful point, isn't it? That the limiting factor is people power, not necessarily the cash itself. Now, while Greif's focus on cost optimization is, definitely commendable, the macroeconomy is still described as not robust, particularly in North America and EMEA. Is there a point where even the most efficient operation just can't overcome a sustained demand slump? Or is this new, leaner portfolio truly more resilient to those kinds of headwinds?
Yeah, that's kind of the key tension for investors to watch, isn't it? While shifting to more resilient markets like pharma and food definitely helps, you're right. No company is completely immune to a really prolonged, broad-based economic downturn. However, their emphasis on value over volume, like in the durable metal segment, combined with that aggressive cost cutting, it suggests they're actively trying to manage for profitability, even if the overall environment stays soft.
So protecting the bottom line, even if the top line struggles.
Pretty much. The hope, I think, for them and for investors is that by shedding the most cyclical parts of the business, they're better positioned now to weather downturns and capture more of the upside when demand eventually does recover, because they'll benefit from that significant operating leverage they keep mentioning.
Okay, so looking ahead then, what should investors really be watching for as potential key catalysts for the stock in the coming quarters?
A few key things stand out. First, obviously, the definitive closings of those 2 big divestitures, containerboard and Timberlands, targeted for August 31st and October 1st, those need to happen smoothly.
Right, execution risk there.
Exactly. Second, continued execution on those cost out initiatives. Are they hitting that $15-25 million target for FY25? That'll be important. Investors will also be watching closely for any updates to the fiscal 2025 guidance ranges, especially as this new, more focused portfolio sort of seasons and they get a better feel for it.
How the new Greif performs on its own.
Precisely. Also, watch deviations in segment volumes as we go into the fiscal fourth quarter. And whether those board pricing tailwinds they mentioned persist, those could be potential stock movers, along with maybe any further footprint actions or plant closures the company might undertake. The CEO, Ole Rosgaard, really reiterated their build-to-last strategy, emphasizing confidence in hitting that $1 billion adjusted EBITDA target by 2027. All right, let's pivot to our not financial advice segment. Let's get a little unconventional here, building on Greif's frankly, incredible financial flexibility post-divestiture. Given they're projecting leverage below 1.2 times and they'll be sitting on a mountain of cash, well, their capital allocation is definitely the thing to watch. Now, management was clear. Dividends, debt paydown, organic growth, M&A, those are the priorities.
Standard playbook.
Right. But here's a scenario, maybe a bit out there, but plausible, that you might want to mull over, especially if you're focused on capital deployment. Imagine this trade idea. Call it the capital blitzkrieg. With $1.75 billion in net cash, proceeds burning a hole in their pocket, and that target leverage range of 2.0, 2.5x. What if Greif did something surprising? What if they committed to a simultaneous, large-scale special dividend A&D, an aggressive, maybe one-time Dutch auction tender offer for their own shares?
Whoa, okay. Both at once.
Both at once. The special dividend hits the income investors, signals massive confidence. The tender offer, probably at a nice premium, significantly cuts the share count, boosts EPS for growth investors.
And how would they fund that? That's a lot of cash out the door.
Well, let's say it's a combined $1.5 billion maneuver. It would be funded mostly by that cash hoard they have. And then, this is the key part, smart. They strategically re-leveraged the balance sheet, maybe taking on some debt, to get back into their stated 2.0 or 2.5x comfort zone.
So using the cash and taking on some debt to return capital.
Exactly. It's audacious, sure. It uses up a huge chunk of that capital very quickly. But man, does it signal extreme confidence in the cash flow of the remaining leaner businesses. And it directly addresses shareholder returns in a way that, let's be honest, M&A might not deliver as quickly or as definitively, especially if those pretty brides, as they called them, are hard to find.
Interesting.
It's a bold move, yeah. It would send a really strong message about management's belief in the value of this new Greif and their commitment to capital discipline, even while dishing out huge value to shareholders. It's like having your cake and eating it too, from a shareholder perspective.
That is certainly a provocative thought. A way for Greif to rapidly deploy capital right back to shareholders if the M&A pipeline doesn't quite deliver those ideal targets fast enough. So, just to recap our deep dive today, Greif Inc is clearly in the middle of a major transformation. They're shedding non-core assets, focusing on higher margin, hopefully more resilient businesses. And despite some of those headline misses on revenue, the strong cash flow generation and the fact they reaffirmed guidance, well, that signals confidence in where they're headed strategically.
And the market's relatively calm reaction suggests investors are, by and large, aligned with this longer-term vision. So what this all means for you, the investor, is that Greif is actively trying to sculpt its future. They're aiming for a leaner, potentially more profitable company. The coming months are really going to reveal how effectively they deploy all this new capital. Will they find those M&A targets? Or could they surprise us with something more direct, like that blitzkrieg idea? That's really the question to ponder as we watch their build-to-last strategy continue to unfold. Okay, that's all for our deep dive into Greif Inc today. As always, remember, this discussion is just for informational purposes. It's definitely not financial advice. We always encourage you to do your own homework, your own due diligence. Thanks for tuning in, and we always welcome your feedback.